My assignment is in 30 minutes talking about the globalization, deglobalization, what it means for markets, what it means for you, for me, for everybody else. Tough job. I'd be very focused on three things only. Number one, I'm trying to make a case, basically saying Donald Trump's reciprocal tariffs are dead before arrival. Okay? It's over. So I'm going to give you my take why it's over. The second point I try to make is anybody who read our research probably would understand that at the height of the crisis, early April, we came out saying, hey, this crisis is not going to lead us to a recession. I'm talking about the United States. And actually, we issued a buy recommendation on the U.S. S&P 500 on April 7th. I'm not trying to run a victory lap here. I'm just telling you that that is what happened. It's printed in black and white. Let me explain to you why we come to that conclusion. The most important thing is what happens next. So that's my second point. The third point, I give you some quick take on the so-called deglobalization, what it means for us as an investor. There's some concerns. Obviously, there are lots of concerns. I will point out a few things that I think matters most for us. First, why reciprocal tariffs are dead before arrival? Because it's based on a bogus theory. It's stupid. It's not going to work. That's why it's dead. There's now this 90-day pause. I'm telling you, after 90 days, he's going to do another 90 days, and then he stopped talking about it. The reason for that is you think about Trump. Trump has been extremely consistent. He loves tariff since the 1980s. If you look at some video clips, when he was young and still looked more handsome than today, he would talk about tariff. And he's incredibly consistent. And I'm trying to get into his mind. What the hell is this guy thinking? Why he loves the word tariff? I cannot find that word so beautiful. He always saying, hey, this is a beautiful word. When you think about his whole thought process, his thought process is actually based on something called mercantilism. Mercantilism was very popular about 150 to 200 years ago. It's basically saying, at the time, we operated in the gold standard. So gold is the symbol of wealth. And all of a sudden, people realize, through foreign trade, you can accumulate gold because any country run trade surplus. You usually import gold. So that's called wealth creation. And vice versa, if you run a deficit, you always have gold outflow. That's called wealth destruction. So I'm not going to spend any time to tell you the stupidity of that theory because Adam Smith already destroyed that theory a long time ago, but Trump picked it up. So he's basically saying, hey, you hear him all the time, every day. Any country runs a current account or trade surplus with us, these countries are ripping me off. They rip us off. And in order to rip them off, we have to bring manufacturing back home. Because in order to create wealth, you have to sell more than you buy. In order to do that, you have to bring manufacturing back. If you don't manufacture, you don't sell more. The problem with that theory is pretty obvious. Everybody who learned economics would understand one thing, which is your current account balance is a reflection of your domestic savings and investment balance. If you have always saving exceeding your domestic if your investment is always exceeding your domestic savings, you have to run trade deficit. Think about that. Some people look confused. I mean, think about this. If you have a credit card, you go out to the bar, you get drunk, you had a great time, and second day, all of a sudden you find that you spend more than you earned. And then you say, that bar is terrible. He sold me so many drinks that I spent more than I earned. Let's close down that bar. Second day, he woke up. He does the same thing again. They go out and get drunk, but this bar is down. The other bar is selling him the same thing. So that's what he's doing. Look at the chart here. I want everybody to focus on the chart. On your left-hand side, the blue line. The blue line is America's trade surplus as a share of America's GDP. Trade surplus with China. Because remember that he hit China first in 2018 because China runs the biggest surplus with the United States. So he hit China with a big bunch of tariffs. You can see that worked. It knocked down the Chinese current account trade surplus with the United States massively. You can see the blue line. So he closed the first bar. The Chinese are no longer selling them alcohols. Now, look at the red line. Somebody else is selling him. Now, somebody else is selling him alcohols. He's getting drunk with somebody else. So all I'm saying here is, it's like dog chasing its own tails. If you do not balance it out, if you do not balance out your domestic spending versus your domestic savings, it basically, you're chasing yourself. So that's why this is a bogus theory. The second thing, why I'm saying, well, that chart is a little bit problematic. But anyway, the second thing I'm saying that this tariff is going to be dead before arrival is that if you think about 100, 150 years ago, the world trade, the international trade is very simple. You produce your stuff. I produce mine. Everybody doing the same thing independently, but we produce different goods. We trade. As simple as that. Under that circumstances, tariff is very useful. If you put up tariff, you protect your domestic producers because it makes everything more expensive so that you protect your domestic producers. But today, the whole story changed. The supply chain is horizontally integrated. I don't know what's the problem with this line, but trust me, I'm not lying. The red dotted line is about 67%. Red dotted line is very important. Basically saying America's manufacturers, they're using imported goods, capital goods, semi-finished products, car parts. That portion of imports is 67% of their manufacturing GDP. 2/3 of their manufacturing is relying on imports. That's why he did not know that. I'm sorry, he really didn't. He announced auto tariff. Remember a few weeks ago, 2 months ago, he said, hey, this is the most beautiful thing happening ever in the United States history. We got a tariff for car makers. American car makers are going to be protected. They're going to do so well. The second day, the car stocks collapsed, 30%. I think, holy mackerel, what happened? This is what happened. Because you are hitting your own guys. You can't separate them. You don't know who is importer, who is producer, who is doing what. They are all mixed up together. That's the second thing. I don't know what this chart is. It's getting this. I think this is not a PDF version. But anyway, you have to trust me. The third thing is that he's trying very hard to revive American manufacturing. This blue line, anyway, just imagine the blue line is continued. The blue line is manufacturing GDP as a share of the overall economy. It's beginning to decline since the 1970s. The red dotted line, you have to really imagine coming down along with it. That's manufacturing employment as a share of overall employment. So these two things has been falling since the 1970s. Trump got into the White House 2016 trying to reverse the trend. He kept telling people, I'm going to bring manufacturing back into America. That's 2017. And Biden administration carried on his policy. They have done a bunch of things, CHIPS Acts, whole bunch of things, trying to bring manufacturing back. I can assure you, this two line, blue and red, continue to fall. Didn't do a thing. You can ask yourself, why? The reason is very simple. If you look at the chart, you don't have to look at the chart, just trust me, but the chart doesn't show you anything. But if you look at the red dotted line, that's the average wage in the U.S. manufacturing sector relative to overall wage rate in the United States. It has been falling. Today, if you work in American manufacture, you are paid 16% less than if you work in any other sector. Ask yourself, can you really revive an industry that the wage rate is below the average wage rate? I am highly doubtful. I come from China. I was born from China. I see a lot of farmers that are really proud that their kids working in the assembly lines. They are really proud. I have not met any American colleagues who say, hey, Chen, tell you great news. My son's working on an assembly line. Great. Sorry, I have never seen anybody like that. It's going to be a problem. So in economic terms, basically tells you, if you wait relative wage decline, it tells you what? It tells you that your industry, the marginal output is diminishing. Very difficult to revive that. The final thing, while I'm saying this thing is dead before arrival, is that they got into trade war with China without really knowing what is going on. He don't trust him. His numbers are always wrong. China basically sell us $1 trillion more than we sell them. Wrong. It's the 300 billion. So you can see the chart here on your left-hand side. The total Chinese export to the United States as a share of the Chinese GDP is 2.6%. Remember that number. The total export, the Chinese export to the United States as a share of the Chinese GDP is 2.6%. Total Chinese trade surplus as a share of Chinese GDP is 1.5. We all know one thing. It's net export that actually determines your GDP growth. So it's really, if you go for a trade embargo, we actually effectively were in trade embargo. We're talking about 200% tariff, 140% tariff. That's a trade embargo. It's not a tariff. So if you drop your bilateral trade to zero, the maximum hit on the Chinese GDP is about 1.5%. Massive hit, but not a fatal hit. Okay? Massive hit, but not fatal. That's why he's saying, hey, once he put that, he would expect the Chinese leader, Xi Jinping, is going to call him begging for a deal. And he didn't. The number basically doesn't add up anymore. If it were 10 years ago, it was a different story. But today, they have already diverted their trade to other countries. You look at the blue line here on the second panel. The Chinese trade way more with Global South than with EU and the United States combined. So that's why he's making a misjudgment. Say, hey, Xi Jinping is going to call me. He didn't. And then he said, why don't you call me? I have all the cards. So the perception is wrong. So these are 4 reasons I think this, I got to grab my time as fast as possible. So the final thing is the perception on the Chinese economy. Everybody's saying, hey, China is very, very export dependent. That was true 10, 15 years ago. Not anymore. This is export as a share of GDP. The US economy is a very closed economy. It's very large, very domestic driven, has the lowest dependency on export. But China is about 20, 18% in that range, lower than France, lower than EU, and almost at par with Japan. So it is sort of average. That's why you got this picture in mind. You have to remember the notion that the Chinese economy hugely dependent on export is no longer the case. That's why, with all that thing in mind, I think this tariff, reciprocal tariff, I don't know where he get this word, reciprocal tariff, this thing is dead. I think he's going to try to settle the American tariff rate at around 10%, maybe slightly above 10% across the board. Is that a big deal? Let me go into my second topic, why I think that is not a big deal. Why the tariff stuff, the tariff war is not going to cause U.S. a recession? This is the reason, very simple. Focus on chart on your left-hand side, the blue line. Blue line, blue. The blue line is the imported consumer goods as a share of U.S. private consumption. Imported consumer goods as a share of private consumption. Less than 4%. People say, are you out of your mind? I said, I'm not out of my mind. I'm telling you the truth, because most of Americans, they spend on what? 2/3 of the spending is on their rent, and big chunk on education, and another big chunk on Medicare. Only 20% of their spending basket is on goods. And out of that goods, a very small portion is imported goods. Total spending is 4%. Do your math. The US economy, GDP, is generated by consumer spending. 73% of the US GDP was generated by consumer spending. That's why I'm saying, hey, jack up 10% consumer goods. Not a big deal. Not a big deal at all. It's about 0.4% impact on consumer spending. Nothing. Okay? So that's why we say, hey, if you're telling me tariffs is going to cause U.S. a recession, you have to tell me that consumers are going to be really get whacked. I don't see that. Of course, if consumers are losing their jobs, that will be a different story. So that's why you have to look at corporate sector too. This is the story here in corporate sector. Corporate sector here on your right-hand side, what's the story? The story is, if you take imported capital goods, semi-finished products, parts, that stuff, you take that, measure that as a share of corporate GDP. It's 16%. 16% of corporate GDP come from imports. So first thing you're going to remember is the impact of tariff is vastly asymmetric. It's minimal for consumers, but it's something for corporate sector, 16%. This something is called 16%. So if you are telling me we're going to jack up tariff across the board by 10 points, the impact on the corporate sector is 1.6%, right? Simple math. 1.6% increase in cost. Think about that as a cost. 1.6% increase in cost. Is that a huge deal? Trump is saying, is that big? Not big. Not too big. Because the corporate sector is always dealing with all kind of price shock. Oil price can easily go up 20, 30%. That's a shock. So all I'm saying here is if it's a 10% You basically translate it into 1.6% cost increase. I don't even know whether that 1.6% increase is going to be absorbed by lower profits or passing on to the consumer. I don't know. We don't know. But all I'm saying here is that 1.6% is not going to drive the corporate sector into a mass layoff. No way. Of course, if you're telling me we're going to have tariff as high as 40%, that's going to change my calculation. If you're talking about 40%, 40 times 16, that's some high numbers. And then you have to take into consideration of retaliation that are going to leading your softer sales abroad. And overall, I calculated the cost increase could be anywhere between 10 to 12%. The S&P 500 average operative leverage ratio is 2. So for every 10-point increase in cost, you are expecting to drop your profit EPS by about 20%. That's why the stock market was actually quite rational. When they talk about 35% tariff, the stock market give you a 18 to 19% decline. That is perfectly in line with this calculation. I have 7 minutes. The final thing here is this. Oh, I'm so sorry. The chart is just incredibly bad. But anyway, the decline so far in the stock market actually is perfectly consistent with something we call technical recession. What is technical recession? Technical recession basically is saying that the U.S. economy has been so weak, you have 1 or 2 quarters zero growth. But it's not a real recession. My clients always ask, what's the difference between technical recession and recession? They are all basically weak growth. So they're totally different. Technical recession is an income statement event, whereas real recession is a balance sheet event. What I'm talking about? Well, you can have a massive bad price shock taking down your profits, but that's your income statement shock. We had a lot of income statement shock. If you think about 2015, we had an oil price collapse causing GDP to weaken quite a bit. Actually, for 2015, U.S. nominal GDP was even lower than real GDP. That's technical recession. 2022, that's a technical recession. We had a 2 back-to-back negative growth. All I'm trying to say is, if you have a technical recession, stock price usually decline about 15 to 20%. But if you have a real recession, the stock market usually start to discount what? Solvency risk. The stock market has to worry whether the company is going to be around or not. That's when you are talking about 30 to 50% decline. So what we have experienced was precisely a technical recession, and we had a technical recession. Too bad the line just gave you one line. I don't know why, but again, you have to trust me. The latest GDP number was a slight negative. You move from a boom, middle of last year, when the GDP growth in the United States was a 3+% all the way to last quarter, minus. You had a technical recession. Now, the GDP nowcast, which is the Atlanta Federal Reserve's model, basically saying you're going to have a rebound. Why am I saying we are looking for new highs in S&P 500? So our roadmap for this year, if you look at our outlook, annual outlook published end of last year, saying first half down, followed by new highs. I think we will see new highs in the stock market. If we don't say it, don't call me. Four reasons. Number one, the dollar has weakened 12%. A weaker dollar is always good for profits because 40% of U.S. S&P 500 profit come from overseas. Dollar has weakened 12%. Good thing. Number two, oil. Oil prices dropped from 80 to 60. Huge drop. That is always good for U.S. economy. It's almost like a tax cut. Number three, I think the Federal Reserve is going to cut interest rates second half. Right now, the market is anticipating 3.5 rate cuts. I don't know. Is it going to be 3 rate cuts, 4 rate cuts? But I think they're going to cut rates. The reason for that is if you look at the inflation, the number looks really good. I'm just trying to tell people, if you look at the labor market, it was really kind of a Goldilocks. You can see the job creation here on the bottom panel. On your left-hand side, we're renormalized the labor market. If you look at a pre-pandemic average labor market job creation, 150,000 to 200,000 per month. We're back to the normal, and wage rate is coming down. Really good. And if you look at the inflation number here on your right-hand side, this is a core PCE inflation. No matter whether you look at a 3-month rate of change or 12-month rate of change, they are all coming down. So all I'm saying here is if inflation coming down, the Fed's going to drop rate. I have 3 minutes, so I got to finish today saying by the last point, why second half of the year, we will see new highs. The last reason is Trump. He's stupid, but not that stupid. He got bloody-nosed on tariff. Second half of the year, he will stop talking about tariff. You're not going to hear him talking about that anymore. He's going to pivot towards corporate tax cut. Okay, he's going to pivot. He's going to pivot towards corporate tax cut. Why? Well, he's trying to settle the tariff rate at 10%, collect the money, and then give it to manufacturing, domestic manufacturing. But the problem here is, as I said, you can't separate them. Domestic manufacturing are also importers. When you think about it, it's kind of stupid. You hit them with 10% tariff, and then you grab that and give it back to you. That's what it is. But anyway, I think the market is anticipating the rapid shift in terms of policy and stimulus. I don't want to go here. This chart is very important. Chart on your left-hand side, the blue line. The blue line is something we call growth tax. It's the combination, it's a weighted average of energy, US dollar, and interest rates. Whenever the blue line going up, it means you are experiencing tax cuts. The financial market is delivering some kind of tax cut for you. And I look at this blue line, the direction of that is going towards stimulative. The direction is the right direction. The direction tells me the stock market will go higher. So that's my second point, why I'm looking at new highs for the remainder of the year for S&P 500. The final thing is deglobalization. I have exactly 60 seconds. Let's deal with that. You kind of see that. But anyway, I always start with the chart. Look at your chart here on your left-hand side. You know who is the loser, who is the winner over the last 35 years. That's when the globalization really started to take off. The biggest winner is the Chinese laborers. You look at their per capita GDP, increased, in real terms, increased 15-fold. Look at the Wall Street. Total return in S&P 500 also increased close to 15-fold. These are big winners. Who is the loser? The loser is the red dotted line. It's American workers. It's employment compensation. American employment compensation is basically flat. Annual growth, 0.5%. The other two guys, annual growth is a positive 8%. This is a close to 0.5. So you see why we have such a divergence, political polarization, whatever you want to call that. Trump is representing the odd. He's a billionaire, but he's representing the red dotted line. So who wants to roll back globalization is the red dotted line. Who want to protect globalization is the Chinese and Wall Street. They've been beneficiary. I'm not here to predict who is going to win the battle. What I'm saying here is the line has been drawn, and the line has been that the Chinese, American capital owners, they are trying to protect and try to continue the globalization process, and then the other forces are trying to destabilize it, to roll back that process. Thank you, Chen. Okay, just 5 seconds. Now, if you think about us as investors over the last 30 years, we have had sustained decline in inflation. We have sustained decline in interest rate. We have sustained increase in equity multiples. Equity multiples. Okay? So, the question to you is, if we roll back the globalization, are we going to reverse the process? If we reverse the process, I don't think it means it's really beautiful for stock market. If you look at the total return index, 15 times increase, 15-fold increase, 40% come from interest rate, multiples. 60% come from profits. So that is the picture. That's something everybody needs to think about. But I know you must have some questions, frustrations, or anger, or whatever, because this is an emotional issue. Call us, writing to us. I guarantee I'm going to reply your question, or your anger, frustration. That's a guarantee. With that, thank you very much.
Thank you so much for that wonderful presentation. Who would have known that alcohol would have made economics so simple to understand?
Exactly.
And here I was thinking about giving up.
Yeah.
You've changed my mind. But what I will present to you, so, okay, with the 5 minutes that we do have left, apologies for the delay. I'm just waiting for my Slido to return. And this is a question that I actually had. Dollar outlook, please. And will U.S. exceptionalism return? I feel like your answer to the latter is yes. It hasn't gone away, in your view.
American exceptionalism, I don't think it's dead, because if you think about American exceptionalism, it's basically saying even though the U.S. economy has already become a high-income economy, it's continued to grow very, very strongly, multiples are much higher than average, then you have to kind of ask yourself, why is that? Why America is so different from Europe? They're all high-income economy. This is like a forever, cannot resolve the problem. Efficiency versus equality. As I said, American economy is organized in the principle of maximizing profits, maximizing efficiency. That's why they always got higher growth, but much higher inequality. You can say 60 million people, America, got no medical coverage. If they're sick, they're sorry, you are toast, whatever that means. But on the other hand, it's a winner takes all. That gives them growth. It's always efficiency first, equality later. Europeans is always equality first, efficiency comes later. That's why they don't have growth. And it becomes economic museum. Nobody want to work. That's as simple as that. So, is American exceptionalism dead? I don't think so.
Yeah.
I don't think it's dead. It's still very much the very principle of that economy. If somebody tells me, hey, the whole system turned towards left, they start to install all welfare payments, everybody being taken care of, that's end of it.
Okay, because there was a time when what was happening in the U.S. Treasury market was challenging the view around American exceptionalism. So maybe going back to the dollar outlook, sir,
Yeah.
you can tell us your view on the dollar, but also the path for treasuries from here, in your view, sir.
When you talk about fiscal, you usually talk about, I think, people are referring to the loss of debt, loss of deficit, what it means for U.S. Treasury bonds, what it means for the fiscal risk premium. I can tell everybody that so-called fiscal risk premium is a bogus concept. It never exists. I'm not saying that lightly. Everybody think about the picture here. 1980, the U.S. public sector debt to GDP ratio was 30%. Today, 120%. Back in 1980, long-term bond yields is 15%. Today, whatever it is. Real yield back then was more than 10. Today, almost zero. Where the hell is the fiscal risk premium? The higher the debt, the lower the rates. That's not only the United States. If you look at Japan, the Japanese public sector debt to GDP ratio today, 240% GDP. For the last 30 years, every year, Japan run fiscal deficit anywhere between 5 to 10%. Year in and year out. I'm not lying. Go and check. Where the hell are Japanese interest rates? Almost zero. This is not only country. Maybe you think about China, same thing. 10 years ago, Chinese public sector debt to GDP ratio is 20%. Today is 90. Interest rate, the Chinese interest rate is now falling to Japanese level. And then if you look across the world, I'm just giving you, trying to convince you this is a bogus concept. Look at the countries that would never borrow. Brazil, Mexico, they hardly have any public sector debt. Their interest rate is sky high. And then you look at a bunch of other countries, they borrow the hell of themselves, like Japan, Singapore, China, Korea, Taiwan. Their public sector, their domestic debt is very high. Not only public sector debt, but also domestic private sector debt is very high, but they got no interest rates. So all I'm saying here is that is a very gold standard. People worry about fiscal risk premium. They are really mixed up the gold standard with fiat money system. The gold standard, yeah, your fiscal policy has to striving for balance the book. If you don't, you're going to run out of money. In the fiat money system, the fiscal policy should never strive for balance the book. That would be stupid. It's a totally stupidity that you every year have to balance the book. No. Your fiscal policy has to be calibrated according to your private sector savings and investment imbalance. If your private sector always saves more than it invests, your public sector should always run deficit. Otherwise, your economy toast. Think about Japan. Japan's private sector always run saving surplus. That's why Japan public sector for 30 years always run deficit. It doesn't mean a squat. It's just an accounting ledger. I'm saying people always show me the public sector debt to GDP ratio. I'm always pissed off at that chart. That doesn't tell me anything.
All right. Okay,
Yeah.
so, sure. One last question. The private sector. So, 1 second left. We've got to do this real quick. Given the small impact on corporate sector of a 10% tariff increase, why do you reckon Trump is pursuing it at all?
Say that again?
Given the small impact on corporate sector of a 10% tariff increase, why do you reckon Trump is pursuing this at all?
Because it doesn't work. It doesn't serve any purpose. So 10%, he's going to settle the tariff at 10%. I don't think he's going to bring back 35%.
Okay.
Because if you do that, we're toast.
Okay.
He knows that he's going to get toast.
Okay.
The key thing is 2026, you get a congressional election. If he got the economy toast, the GOP will be wiped away.
Okay.
And he become lame duck. He's not that stupid.
Okay, got you.
Yeah.
We leave it there, sir. Thanks so much for your time.
Thank you very much.